Let's look at this Aflac breakdown. And none of this is going to be investment advice. So this is Aflac AFL. That's the ticker. This is just how I'm looking at this particular company. And we're going to do a little bit more technical than what we probably would normally do, because this really is a very much a technical move. It's not really a move based on the fundamentals. A little bit of fundamentals, but primarily a technical move. Now, one thing you'll notice is I don't have a lot of really sophisticated indicators, because everything's about price action to me, right? So I don't need to look at the latest, greatest technical indicator, and I'm not looking at this for a daily trade. So I'm looking more of a price trend, right, over an immediate period of time. I would say greater than 2 weeks, less than 6 months. I'm not looking to try to trade this on a daily, so that's probably why I don't have to use a lot of really multiple or complicated indicators, right? And we're looking at AFL, that's the ticker. We're looking at the 5-year, we're looking at the monthly candles. And we're looking at that 5-year, looking at the monthly candles. What we see is that on the monthly, there was resistance around the $56 mark, let's say in that particular range. And then we also had a resistance around the $64 mark. This 56 was resistance. Later on, it became support. On the monthly, it bounced outside support and it moved up past the $64 resistance, and it's over that now. So now that $64 is going to become support on the monthly candle, right? We want to see how we close out this month, whether we close out above or below that 64. The month is getting ready to go to a close. And then we also want to see where do we open up next month around that 64, 65, 66 resistance, whether we open up on the monthly candle above or under that particular mark, right? So that's on the 5-year, okay? Now we go to the 2-year. We're going to pretty much look at the same thing. So around 56, we have this as was a resistance. It became a support. The 64 became a resistance. Sold down. It bounced up off of it. Hit that resistance again. Sold back down. Bounced off that support and moved up off of it. So this is on the 2-year on the weekly candles, right? So what you'll see a lot of times is that when you find a long-term support or resistance on the monthly, a lot of times you're going to see some level of consistency through that. Not 100%, because like I said, we're dealing with a shorter time frame on the weekly candles, but you often will see some level of consistency through that when you start looking at it in a shorter time frame. So that's the 2-year. Now let's go to the 1-year on the daily candle. So we can get a little bit more in depth now, because like I said, we're looking at daily movement. So we're going to see a little bit more volatility, and we're going to start to see the ranges starting to get a little bit more stretched because we're looking at day to day as opposed to a 5-day period or opposed to a 30-day period, right? So we're seeing this $66 resistance. We're also seeing a resistance around, what is this, maybe 64. And then here at this 56 again as a resistance, but also support. And so let's look at it from November of last year to November of this year. Hit the 64, sold down, moved up over to hit that 66, sold all the way down up under that last support, moved back up over it, right? Bounced, hit it again, sold all the way back down. This became a decent support, even though we got a little bit under it on the daily, right? We trended back way under it, okay? Traded under it for a while, moved back up, hit that 64 again, sold back down up under it, bounced off that 56 and moved up. So to me, from here to here is where this ticker was probably the most dangerous to try to trade it. Why? Because it really wasn't. So there is also a support under here around this 52, but I didn't plot that out. So what happens is you moved under here, you traded in this range, and then you established a new support. Because to me, it was a newer support on the daily. You have a lot more day-to-day volatility is where the trade started to become really dangerous, right? But what we saw is that we hit this support at around 56, and then we moved past all our previous resistance points, and we're now way above it. Now, what we're seeing, to me, in my opinion, is that AFL is starting to look very, very much extended. And what do I mean by that? Let's look at it again on we're going to look at it on a 5-day time frame. But what I want to show you really quickly is that we have a 52-week range of $52 to $71.93, right? So we saw that here. We started to see the 52 be that low end support, now up here into the $70 range. What we a lot of times see in the market is when companies hit their 72-week high, they sell off. So here's what I would do, because I can't give you investment advice. If I was looking for trades in the market and I didn't want to do a lot of mental work and I wanted to make things easier on myself, I would just look at scanners for 52-week highs. I think a lot of times we make this a little bit more difficult than what it really is. I would say, what companies have hit their 52-week highs? And then I would just do a lot of charting just on the resistance and the support around that 52-week high. And then I would try to create a narrative that, one, why did it go above its 52-week high? Is there something that's fundamentally changed in the company? Is there something that's going on in the macroeconomic situation? And how long do I think it trades at that 52-week high before what? Most people start to look to take profit. Many times in this market, when a company hits its 52-week high, not every time, but many times when a company hits its 52-week high, people start to look to come in and take profit. Why? Because it's at a high point, because they believe it's going to sell off once this enthusiasm is over, and I can always buy back in at a lower price, especially if I don't have to pay capital gains on this. Many people will buy into a ticker. If I've been holding it for 5 years and it hits a 52-week high, and I don't believe that it's really based on a fundamental change in the company, it's just based on enthusiasm, I can sell out, not have to pay my capital gains. This is my own opinion. It's not tax advice. Not have to pay my capital gains because I've held it for an extended period of time. Then I can buy back in at a lower price because I believe it's going to keep going up, but I want to cash out now and take profits. And a lot of times what you see, when you see a lot of bullish activity, you often will experience profit taking, which is why it can be dangerous to chase it if you don't believe it's going to be extended, right? So we see the 52-week high being around 71.93, and we see the 52-week range being 52 to 71. So we see on the chart, let's go back to the 5-day. And I don't want to be on the 5-minute candles. Let's do the 30-minute candles. We see once we get around that high, we started to sell off. So let me zoom this in a little bit more because we're well past 5 days. So we see is once we got around that high, we sold down off that high. The question we want to ask ourselves is that, do we continue to sell down off that 52-week high, or do we believe that the market has created a narrative to sell this higher than this 52-week high? So what is the story around this company that is going to make people want to continue to pay higher and higher prices for this company? Here's something else I would look at. Go to the 1 year. Let me get rid of all of this, right? And hopefully it doesn't get rid of all of them on all of them. I would go to the indicator and I would just set up like a basic 200-day moving average. Let me go to that, make that a yellow. Okay, so we know it's way above that. And then I would set up another moving average. Let's go to the 50. Let me get a color that I think is stand out. Let's do, I don't know, let's try that. Okay, so what we're looking at right now on the 1 year, it's well above the 200, and it's also well above the 50-day moving average. And it started to really move above both of those, was that late, around this time last month. We got really strong movement, and it was over them before, it sold down. So then the question we're looking at now is on the 1 year, it's well above the 200, it's well above the 50. We know it just hit its 52-week high. What is going to be the narrative around this ticker that's going to make people continue to want to pay higher and higher prices for it? Because on the 50-day average, it's getting higher, it's getting more expensive. On the 200-day moving average, it's getting way more expensive. We can add another one in that I like to add in. And none of these moving averages are secret numbers. They're not like I got the secret number that makes the trade work all the time. That's not how this works. What I'm just trying to figure out is that, like, what is the average price that people were willing to pay for it, and how are we moving up off that price? So we're seeing that it's way off the 23-day moving average also. So we're starting to really bend very hard off our moving averages. So you look at the moving average, look at how the candles are closing, even on red days, way higher than these moving averages, right? On the daily, okay? Let's go to the weekly. So way off the 200, well off the 23, and well off the 50, right? From a moving average. The question I would ask myself is, how long are people going to want to continue to pay a higher and higher price, especially on the 50 and the 23. The 200 is not that big of a deal, but on the 50 and the 23, how much longer are people going to continue to want to pay this higher price? Because this is about where we started to see selling above the 50 and the 23. It moved under. We got around here again. We started to see selling up under it. Now we're way above that particular range again. So the question I would ask myself is that how long are people going to want to continue to pay way above the average price on a 50 or 23-day standpoint above what it historically been? Now those averages, that average movement, has started to adjust itself over time as we continue to go farther out, especially if the price continues to go up, because we see the 23 starting to curl up, and we saw this a lot more on the daily, right? So let's go back to the daily. We see the 23 starting to curl up, it's chasing it. But look at the space between the 23 and where the candles are closing at. That's what we want to ask ourselves. It doesn't mean people won't pay for it. It means that we just want to ask ourselves, as this thing starts to become more and more expensive relative to its average price historically over these time periods, how long do we think the market will keep paying the price? So like I tell you, the only thing on the chart is price action and volume. There's nothing else. But I said before, I'm not looking to trade this on the daily. So no disrespect to my day traders, big up to them, but I'm not looking at this on the daily trade. I'm looking at this for a longer time period, more extended. Now, one thing I would watch out for is that this ticker's a slow mover in comparison to the rest of the market, right? Beta at 0.92. This is a slow mover. Therefore, if I was to get into a trade on this and if I buy it on a shorter time frame, let's say I buy monthly and I don't get the movement, I could be in trouble because why? It's a slow mover. So I would really watch my implied volatility, and I would really watch my delta. I would make sure that any return on it when I buy the contract, any dollar movement is going to pay out from a delta standpoint, because I can get in trouble because this is not a fast moving ticker, which means that the volatility on the options can be very low because the volatility is not going to be baked in. So, but we're in a very much of a bullish pattern, right? Float 617, 600 million shares, got an institutional buy-in of around 60% of that. The float's not really being shorted that much. So I wouldn't look for shorts to come in and drive this down. But what I would be looking for is profit taking. This is a really relatively well-managed company. They're an insurer. Like, it's how do you not make money in the insurance business, right? I mean, they don't pay out the majority of their accounts. January 31st is the next earnings, and earnings is guided down from the last earnings, right? So it may not be difficult for them to hit that earnings, okay? But this is what you want to really look at. We're kind of at a top. The top is 71.93, right? And that's from last week. How do we open up going into the end of the year? Right? I'm sorry. How do we open up on Monday as we get ready to push towards the end of the year? But what I would look out for, and let me get rid of these indicators again. What I would look out for is profit taking. Now, looking at the options chain, what I noticed is, let me see if I can get the right date. Okay, so on this date, December 16th, and this may be what we call, I believe, a straddle. That $70 put to $70 call, I have more volume than open interest on both of them. That worries me because what it could be is that the market is just playing this from both sides. In their mind, it could continue to go up, it could continue to go down. The question is, when you make this type of play, is it worth the premium that you're going to outlay based on the return that you think you're going to get? Because what you really wanted to do is run on both. You wanted to run in either direction. I believe it's going to run to the upside, or I believe it's going to run to the downside. That's going to make the cost of me buying the other contract on the opposite side worth it. But I want to see on Monday, does that volume move over to that open interest, or was it just being traded that way on the day? And then when we reset the contracts on Monday, that they have closed those positions out, and that open interest is still going to be the 920. Let's say it might be 950, maybe even 1,000, but it won't be over 2,000. And the same thing with the puts. Let's say the put open interest might be 200-300, but it won't be over 2,000. And one of the ways in which you can look at a hot contract is that if you start to see volume greater than open interest, which means that there's a lot of people on that particular strike and they're trading in and out of that. But one thing I look for is, does that move into the next day? Now you can play it that day. and it might work for you. But in this scenario, what they're doing is they're playing, to me, what we call a straddle. And I hope it's a straddle and not a strangle, but I believe it's a straddle play, to where you buy the same expiration date, the same strike on the call and the put, to hedge against the risk of the play not going your way. The problem, like I said, is the return worth the outlay of the actual premium, right? So that's what I'm looking at. And then there's some other tickers. That's the closest one. I didn't see a lot of open interest on the 2nd, the 9th, or the 25th. I wouldn't buy the 25th. To me, that's too close for a slow mover. In my opinion, I wouldn't even deal with that. And I don't see a lot of open interest on that particular ticker, or any of those strikes, I'm sorry. Looking at the January, you see good call action here, and you see the call starting to go up, and that makes sense because it's moving up, and the puts are starting to lose premium. But the 25th is what stood out to me, because that made, not the 25th, was it the 16th? My bad. The 16th is what stood out to me, because that's where I start to see the volume greater than the open interest. There is open interest all up and down this particular chain. And I would just look for a contract that I think works for me based on what direction I think it's going to go. But I would, like I said before, a real easy strategy to find tickers is to find anything that's at its 52-week high. And you can find that, I think you can probably do that through FinViz. Or if you can't, there has to be a way to find it, because these markets track 52-week highs. I think Yahoo has literally a tracker that tracks, everything that hit its 52-week high. And a lot of times, if you just use your creativity around in these markets, you can find opportunity just because you have a basic understanding of how the market functions, and then you just use your creativity. That's going to be the Aflac trade. Like I said before, this is not investment advice. This is what I would do. And this is the kind of work that I normally do on a Sunday. I would just look at it. And like I said, as I learned from Lance, I think that's BHC Capital, LLC. She's been on the plan before. She's also in the VIP course, and she teaches in the VIP course what I just did, is how to look at a very extended time frame, break it down, 5 year. Sometimes you can even look at lifetime, but with some tickets, you're going to be looking at too much, right? Look at 5 year, 2 year, 1 year. Then you can break it down to, 1 year weekly, then 1 year daily. Then you can break it down to five days. Then you can break it down to 10 minutes. And what you see a lot of times is that support and that resistance will stand up over all those time periods. If you want to just trade it technically, you can do that. But what I like to do is incorporate, why did this move up? And one of the reasons, if you're looking at Aflac, is they did they had their earnings. They did, I think, 100 billion. It might either be a billion or a million. But they did a large stock buyback. And a lot of times, because of people's perception of what that means, it can create a lot of bullish activity around a ticker. It doesn't really change the company, but a lot of times it's a psychological play to where the market perceives that stock is going to be more valuable in the future, because their attitude is that the company is going to start buying up shares. And people a lot of times start looking to add on. Aflac also pays out a really nice dividend, right? Because like I said, they're an insurer. Like, if you can't make an insurance company work, you just got really bad management, because their job is to not pay out. Their job is to the insurance company makes money because they sell you a premium that's really overpriced, and then they don't pay out. So you're paying for a premium that is overpriced. The premium that they're selling you, they underwrite it, and then they figure out how to put a multiple on it so they make money on the premium. They don't pay out, and then they take the premium money and they invest it in the market, and they get a return. Therefore, if you can convince people to buy the insurance, which you do need as an emergency vehicle, but most people are never going to redeem their insurance. I've had car insurance. I think I've been in 2 accidents in my whole life. I've had car insurance literally for decades. So I've been paying this car insurer money every month for decades on a premium that's overpriced. If you can get a volume of people, a critical mass of people, like, how can you not make money at it? So they're giving a dividend back. They're also buying up stock, which is going to skew the EPS, make the company like it's performing better. And so I think that created a lot of the bullish activity. But my question is, one of the things that we see a lot of times around that 52-week high is people start to look to take profit. Doesn't mean they'll do it this time, but it means that's a lot of times what people look to do once they hit that 52-week high. People look to take profit. then we have to try to figure out in this market, how does it reset? Let me look at the financials real quick. My bad. Let me look at the stats. So the forward PE is really not that bad, but that's also going to be industry specific. So I would need to look at, based on every other insurer in their industry, what is the average PE ratio, to try to determine whether or not I think people are overpaying for that stock. Because based on the current price of the stock and in the forward PE, people may start to feel like it's too expensive based on what the cost of capital is going to be in the future. Hope you got some value from it. David W. Williams, also known as Diamond Dave. Talk to you later.